exchange market. And in the foreign exchange market, we're looking at the value of a currency. So normally you only have to draw one of these or analyze one of these, but I think it's useful to have these side by side so you can see how something happening in one impacts the other, because normally they're asking about something like that. Okay, so in this, we're assuming that only the United States and some nation in Europe exists. For the sake of this, all other things constant. So we have to label first. So we always do foreign over domestic. So here we're going to do euro, our foreign currency, over our domestic currency or of the dollar. So in the event that the euro price per dollar goes up, that means each dollar uh, costs more euros. So it might go from 50 euros for $1 to 100 euros for $1. That means the dollar has appreciated in value when the price of it goes up. When the price of it goes down, that means the euro per dollar that you get, the amount of euros per dollar goes down, so the currency has depreciated in value. Okay, and then over here we're going to have the quantity of the US dollar. I'm just going to put that right there. Here we're going to have foreign over domestic because we're looking at the euro. Our foreign is the dollar. Our domestic is the euro. There we go. And down here we're looking at the quantity of euros. Okay. Now, normally they're going to ask you or indicate one of three things is happening. Either there's a change in GDP for one nation versus the other, change in relative interest rates for one nation versus the other, or a change in inflation for one versus the other. So let's take a look at what that means. Uh, let's start with income because income and interest rates are the most common. So let's say the GDP in the United States rises relative to that in the European Union. What's going to happen? Okay, so GDP rises here greater than European Union. Now, we come over here, we're going to draw in our demand, and we're going to have our supply. Right? They're just normal demand and supply curves, and we get our equilibrium here. And then this is going to be our exchange rate, the amount of euros per dollar we can get. So that's exchange rate 1. We dash down, and this is our quantity. We're going to jump over here and do the same in Europe. We have our demand, and we've got our supply. We've got our equilibrium, and then right here is going to be our exchange rate, the amount of dollars per euro, and our quantity. Now, in the event that our GDP goes up, relative speaking, it means that we're going to be buying more of everything. Our income has risen. Our national income has gone up. So as a result, we're going to want more European imported goods as well as all other goods. We're going to want more of them. We have more money. We can buy more of those goods. In order to get European goods, we have to supply US dollars in the market. So our supply is going to shift to the right. Let me change the color so that you can see here. Supply is going to shift to the right because we want European chocolate and European socks and European sweaters and all those things with our new income. So when supply goes up, our currency is going to depreciate. That's what happens in the US. Well, what happens in the euro when the United States income goes up relative to theirs? Well, what happens is we demand more of their currency. We're trying to buy their European socks and European chocolate and everything like that. So demand is going to go to the right. When demand goes to the right, their exchange rate is going to rise, or in other words, their currency is going to appreciate, increase in value as a result. In other words, the opposite happens in the European Union as what happens in the United States. Okay, well, let's say that our interest rates in the United States, our interest rates go up. What's going to happen? Okay, let me clear this out. Hopefully that makes some sense here. I'm going to clear this out and draw it again and show you what happens when just interest rates go up. So just interest rates are going up in the United States. So IR up here. Okay, I'm going to real quick redraw these graphs. So I have euros, foreign over domestic. I've got my quantity of the dollar. Got my quantity of the euro. I've got my foreign, which is the US dollar here, over my euro, which is my domestic currency. I've got demand. I've got supply. Initial equilibrium, initial exchange rate, and the amount of currency being exchanged. It's Q1. And then down here, I've got my demand. I've got my supply. Got my initial equilibrium, which gives me my initial exchange rate, IR1, and my initial quantity, Q1. Shoo. Okay, so what's going to happen? Well, if the United States interest rates are higher, it means that our domestically provided bonds are going to be more valuable. So instead of buying European bonds, I'm going to buy American bonds. So what happens as a result is I actually end up either supplying less of my bonds or less of my money into the market, or so I can draw it that way with supply shifting left, appreciating my currency. Or instead, I flip the perspective. And I think this is a little easier to explain. So I jump over to the European Union. What will the European Union do if the United States currency increases or the interest rates increase? Well, the US bonds look much more attractive because they're going to pay me more money back in the future. So as a result, from the European Union's perspective, I'm going to supply more euros in the market to get US dollars to buy those bonds with those higher interest rates. So supply is going to go to the right. My exchange rate is going to go down and my quantity is going to rise. Well, what's going to happen over here? Well, what's going to happen is the European Union is going to demand more of my currency so that they can buy my bonds that have the high interest rate. So the demand for the US dollar is going to shift to the right. When demand shifts to the right to D2, my exchange rate goes up. The currency appreciates, so ER2, currency appreciates and the quantity being exchanged rises as well. Now, the secondary impact is when our exchange rate goes up and our currency appreciates, what's going to happen is my exports, my net exports, are going to go down in the United States. Because when my currency appreciates, my exports that I put in other markets are going to look relatively more expensive. That's almost always a follow-up question. So just know that there's an inverse relationship between the value of the currency and that of exports. My currency goes down in value. If it's depreciating, then net exports will go up and vice versa. The final one is inflation. This is a lot less common, so I'm not going to draw it here. But if in the United States there's a high inflation rate, then my goods are going to look relatively more expensive to foreign investors. The demand is going to go down for my currency. My currency is going to depreciate in value. Right? The reason it looks more expensive is because the price is astronomically higher in the United States, and that price carries with those goods into foreign markets. Okay? So if you need more explanation on inflation, you can look in your notes or have a conversation with me tomorrow, but I hope that's helpful. That's your foreign exchange market in a nutshell.